to talk about some of what emerged from the Monetary Policy Committee's meeting, the outcome of that meeting, and also with regard to transmission and bank credit, because there were a few comments on that, I'm joined by Ashwini Tewari, who's Managing Director of State Bank of India. Mr. Tewari, thanks so much for taking the time. And we also have got, still at the Reserve Bank of India, NDTV Profit's Banking and Economy Editor Vishwanath Nair, who will be speaking to you today. But Mr. Tewari, our house was a little divided on whether or not there would be a front-loading of rate cuts. I wonder what you think. And do you think that this is a pragmatic decision? Inflation tending lower, but not enough time has elapsed for you to see the complete effect of what has already been announced.
No, good morning and good morning, Vishwanath. So basically, our house economist, Dr. Ghosh, was on record saying that 25 basis points could be cut so that the festival season loans, people could be enthused a little bit for the festival season. Now, that has not materialized, as we all know. So the overall picture anyway is 50-50. In terms of the repricing which is going on at the moment, almost 70-80% of repricing for the previous cut has already happened because external benchmark gets repriced immediately, whilst the MCLR for most banks also has a deposit cost. Until that moderates, the pass-through is not to the extent of the rate cut. So in that sense, that is still playing out. Our view now, as we saw the inflation forecast, which is the Q4 and beyond, is a little higher. So I think the governor has played a little bit cautious, which is warranted, especially because of the tariff situation is not yet clear at all. And despite the tariff situation not being clear, the GDP growth forecast has been maintained, which tells us that there are other factors supporting the growth, though the tariff thing is a lot of uncertainty here. So I think overall, partly on expected lines, I would say.
Mrs. Tewari, Vishwanath here. Quick question around the comments about credit growth that the governor made. He's talked about the fact that yes, bank credit has not been growing that fast, but however, the flow of resources to the productive sectors of the economy has been steady. Bond market specifically, a lot of corporates are going out and borrowing from there. Not very long ago, actually, maybe a few years ago, the RBI referred to this as lazy banking because banks were putting money in the bond market and not really in the form of credit to their borrowers. How are you seeing the shift in sort of approach that generally money is moving to borrowers, so it's okay if it's direct loans or bonds, doesn't really change anything?
So the first thing is that the banks are not asking the borrowers to go to markets and all. It's a borrower's own choice that they find the flexibility in the short-term rates, which might be lower than the bank rates. And also, many of them have raised equity through a lot of IPOs and follow-on offers, etc. this year. Many of them also have a lot of cash surpluses because fresh investments have been a little less. So overall, whoever wants to invest and whoever wants to do the activity, the banks are always supportive, always there. But it's a mix of the options they have, which they are using. Having said that, we still see good growth in the MSME segment. We still see good growth in the retail mortgages, the housing loans. So overall, that way, the credit growth, though it has come down, but largely in the large corporate side.
I also wanted to get a sense from you about this festival season, because you mentioned that your house economists had believed that a front-loading of rate cut was essential because during the festival season people would need lower rates. To your mind, even without that 25 basis point rate cut, does this festival season promise a good year?
Every year it happens. So this is a time when most people want to buy vehicles, new consumer goods, etc. So to my mind, 25 basis points, though, could have given some more positivity, but overall, I don't think it's going to make too much impact on people's intention of buying or increasing the consumer demand. So it will still happen, to my mind.
Got it. Mr. Tewari, I just want to ask about transmission so far. So there were some figures that were shared by the Reserve Bank of India governor, but specifically for State Bank of India, I'm wondering what percentage of the book currently is still with MCLR and what is the transmission there? When do you see the culmination of the transmission taking place of what we've seen so far?
So as I explained in the beginning of my remarks, almost 75 to 80%, between that number, the transmission already happened, because around 60% of the book is the external benchmark linked rate, which is repriced immediately. and about 38, 39 is, 38 is about MCLR, so which is taking some time. We have had some cuts, but some more time may be needed for the full repricing. The base rate and all is very small now, so therefore broadly about 80% of the transmission for us has already happened.
Mr. Tewari, the transmission of deposits is still underway. The expectation is that by end of Q2, that is by September 30 is when most of that transmission would happen. To your mind, could that timeline get extended by any way, or are the indications that Q2 is probably the end of that point where the deposit transmission ends?
So see, deposit transmission is not a straight linkage between what the policy rate cut has happened. I mean, as you are aware that we did cut our saving rate also, which normally we don't, and fixed deposit also we have cut. But we have to also see that depositors do continue to get a fair rate, which should be competitive as compared to the small savings rate and the other rates which are available in the market, because otherwise they have the option to go to those channels as well. And therefore, we have to be cautious when we do this rate cut of deposits, whether the demand for deposits is going to come down significantly. So we keep that in mind, and that's why it's not a given that the full transmission of deposits rates will be equivalent to whatever the lending rate cuts will happen. It will be a function of demand and supply.
Okay. Mr. Tewari, when you're talking about the offtake of loans or the growth in credit, you mentioned that corporates have been venturing out, and for various reasons. They've been also raising equity, as you've pointed out. That frenetic raising of equity continues even as we speak, and there's no reason to suggest that that's going to dry up anytime soon. So would you say, therefore, that we're going to see more of the same in terms of credit offtake in the rest of the financial year? Or do you anticipate that some of the benefits of the lower rates will start trickling through in the second half?
So the key question here is that new investments being made, because otherwise, as you rightly pointed out, the regular demand, people have used options of equity, options of the other market debt instruments, etc., which have gone up significantly. New investments were a little tepid. However, we do see some demand coming up in terms of project loans, etc., in the renewable space, in the road space, in the commercial real estate space. That's where we see some demand coming up, and we are hoping that this crystallizes to a wider sectoral demand rather than just a limited few sectors demand as it is now.
Mr. Tewari, the RBI governor also talked about the new liquidity framework. He's also spoken about the fact that the CRR cuts will start playing out now. To your mind, then, does the general interest rate in the economy go down significantly further, or would you say that maybe it will be a little bit lower than where we are right now?
So the liquidity position is comfortable, as was pointed out, and after the CRR rate cuts come into the system, the liquidity will further increase. So I don't see any challenge with liquidity. And in terms of the real interest rates, actually, if you look at the 3-month Treasury bill rate, it is the reduction there has been lower. Higher than the overall 100 basis points cut which was done. So therefore, because of the enhanced liquidity and because of the pricing pass-through, the actual rate to the end customer, more largely corporates, has been even higher. So I think that repricing and the pass-through has been happening very well. Liquidity overall in any way is very, very comfortable.
Mr. Tewari, putting quite a bit of what we've spoken about together, I just want to understand, there is broadly an expectation that NIM compression or net interest margin compression will eventually happen because of everything we've spoken about, but there will be a certain amount of defense that will come through because of the impact of the CRR cut, which starts in September. On balance, what is the kind of trajectory or glide path that we're likely to see, not just for your bank, but pretty much the banking system?
So in general, the banks will see a NIM compression for the reason that the loan repricing, as I explained, with the external benchmark is done or substantively done, whereas the deposits reprice with a lag, because the term deposits, which is the major driver in the system now, nobody will do a premature payment because the revised rates will be lower. So therefore, as and when they mature, the new rates will kick in, and that's how the repricing will happen with a lag. And typically this lag is almost 2 quarters and more. So that's why now this repricing is, as we speak, happening. So therefore, as the lag, because one is because of the lag effect, and secondly, as I explained, because the reduction in overall interest rates, especially on the 3-month T-bill, etc., is higher than the rate cut made. The loan rate cut, the loan repricing is higher. So these two factors together actually are a little bit higher NIM compression. When there will be some support from the CRR cut, but I don't think it is going to be enough to staunch this NIM compression. Overall, there will definitely be a NIM compression.
I want to ask one last point to you, sir, about the re-KYC that the RBI governor pointed out, that because the general accounts have completed a certain number of years, so you're going to see a re-KYC of these accounts. At district level, banks are holding camps. To your mind, is this a complicated process, or do you think that banks are pretty much adept at handling the rush that might come in?
It's a large issue for sure, because as we are aware that in 2014, 15, 16, those 2-3 years, almost 32 crores or 320 million accounts were opened. And starting from 2024, which was last year, almost all of them will become due by next year. So while some time has been given by the RBI till June next year, but these all have to be, the re-KYC has to be done. The re-KYC process per se is not that complicated if a person is available, because largely it is Aadhaar-led e-KYC process. So therefore, the person needs to be present. And in case the person is not visiting the branch or the CKY or the customer service point of the business correspondents, then the only other option is for somebody to go to their place and do a video KYC. Video KYC is slightly more cumbersome in that sense, because you have to reach out to each customer rather than the customers together coming to a point. So these camps, to my mind, are a good way to actually increase awareness about this issue, because they're all being done at the panchayat level. And they are not only re-KYC, they also have the opening of micro insurance accounts like the Pradhan Mantri JJBY Yojana and SBI, and also the opening of some more accounts where warranted in some cases. So all of this together, this will create a lot of awareness at the village level, and our hope is that this will motivate people to reach out to those customer service points, which are the major drivers in all this drive for all of us, alongside the bank branches, which will guide this process.
Absolutely.
Because we got to complete this by next year in the time. The volume is just too large.
Absolutely. Sir, thanks so much for taking the time. Really appreciate the time you spent with us.